Hey everybody, Ashley Page here. Hope you are having a great week. We're thrilled that you're with us today. We're responding to some client questions this morning about some of the news that's going to come up about the size of the Federal Reserve balance sheet. So we want to do this educational vlog for you this morning on simply this question. What are the two main ways that the Federal Reserve impacts the economy? The first one is the one that you're most familiar with, and that's what they do on interest rates. If interest rates go up, cost of capital is higher. If interest rates go down, cost of capital lower. Very straightforward. But in terms of the interest rate part that we see in the popular press all the time, what you will see more of in the coming weeks, and it's something that maybe most people don't know much about at all, is the size of the Federal Reserve balance sheet. That has been a major topic really since 2008. And you'll see a lot more discussion about this second impact over the next few weeks. And here's why. What our Federal Reserve does, as opposed to other central banks around the world, is that our Federal Reserve has what's called a two-prong mandate. It manages the economy through interest rates. It tries to manage the employment number. Many Federal Reserves around the country don't do that. They've got one or the other. They aim at employment or they aim at interest rate. Our Federal Reserve is unusual in that they try to do both. And again, they do it with interest rate change and balance sheet size. As the graph will show you, after the financial crisis in 2008, the Fed's balance sheet is like any other company that you can think of, the Ashley Page Tool and Die or whatever. You've got assets and liabilities. The Federal Reserve is no different. If you look at what the assets the Fed holds, they're mortgage bonds, U.S. Treasuries, and then a small collection of other items. If you look at what their liabilities are, and that's really kind of what goes to the core of what the Fed does, you'll see that there's the currency in circulation, the money in my wallet today, and the money that's going in the banking system for goods and services. That's first. The reserve balances that they keep for the U.S. banking system, and finally the U.S. General Treasury account. So they're like any other public or private company in that they have a balance sheet where they've got liabilities and assets. The Federal Reserve as a total balance sheet size was only about 1 trillion, that's trillion with a T, just before the financial crisis in 2008. As the graph will show you, that quadrupled in the time of the financial crisis. And the reason for that is that the Federal Reserve, what we're able to do in our economy as opposed to Europe, we have what's called an active capital markets group, meaning commercial paper. If you look at Europe, for example, pretty much all they have is a traditional banking system. So if I'm getting capital for my company, I'm usually going down to the bank and borrowing it. In the United States, we can both borrow from a bank or companies can finance themselves in the open commercial paper market. What the Fed in the United States can do by growing a balance sheet like that is it's like putting oil in your car engine. It gives it liquidity, if you will, where it can run better and faster. So that's the benefit of our Federal Reserve in a financial crisis like that. We can grow the balance sheet by putting a lot of cash into the system. So that was historical in 2008. We've told you that on many vlogs before. We had never seen a time like that. Then when we got a better economy and started to shrink the balance sheet, it got up, as you can see on the graph, to about 4.5 trillion. In the last couple of years, we've started to bring that back down. It's about 4 trillion now. And that also was historic. We were in historic times to build a balance sheet like that. We're in historic times to reduce it. We were on a fairly steady schedule with the Federal Reserve of reducing the balance sheet back down. But in terms of keeping our economy really good, probably what you'll see coming up is some discussion from the Fed, maybe to level off a little bit from what this decrease path we were on. And the simple reason for that is the Fed, when they hold onto or own more U.S. Treasuries in the system, that has a tendency to help U.S. economic growth. So when we were bringing the balance sheet back down to more normalized level, you will probably see that effort level off a little bit, or at least the pace of it slow down. So in addition to the interest rates that you're very familiar with, The Fed can also impact the economy by how large its own balance sheet is, much like a company of any other type. So we hope this is helpful to you. If you got any extra questions about it, call myself, Greg, or anybody on the portfolio team. We always appreciate you seeing these vlogs, and we're delighted you're learning from them. We're also really excited you're forwarding them to others. Thanks.